What's up guys, welcome back to another YouTube video. In today's video we'll be talking about risk management. That is, we're talking about risk and how we can actually manage our risk. This is another video. This video is part of the mentorship program, and you can say this is the 5th video of the mentorship program. So if you are just joining us for the first time, consider subscribing to the channel and you can go down and watch other videos that are related to this mentorship program. Risk management is one of the topics most traders don't usually talk about. Most traders focus on the strategic part of trading and then forget about risk management. Looking at the diagram on your screen right now, you will see that strategy occupies the smallest space in the diagram, which tells you that risk management and trading mindset plays more important role than strategy in our trading business. So if you want to be a successful trader, don't go about looking for only the best strategy or looking for only winning strategy. Don't just go about looking for where is your entry or where is your exit. Also try to understand how to manage your risk. Try to master your trading mindset, because once you understand these two things, I'm telling you the truth, you will be a profitable trader, because risk management plays an important role in this business. Once you understand risk management, it's gonna separate you from losing traders. Most of the traders that lose their money easily, they don't understand how to manage their risk, and that makes them lose a lot of money in trading. So if you really want to succeed in forex trading, in crypto trading, in stocks trading, or you trade futures, you must have a specific risk you take on each of your trade. Let's say you risk $100 on each of your trades. Stick to that. Each of any trade you open, stick to $100. You can actually increase your risk as your account grows. Have a specific risk you take on each of your trades. Not today you are risking $100, the next day you are risking $200, next tomorrow you are risking $50, the upper day you are risking $500. It's not done that way. Have a specific risk you take on each of your trades. Hope I'm making myself very clear. So have a good risk management plan that will actually protect your account. Now, what is a risk management plan? A risk management plan protects your trading account. This plan helps protect your trading account. It keeps your account safe when you must have encountered series of losses. Yes, like you know, in trading we lose money sometimes. It's not guaranteed that you will win all your trade. So a risk management plan is a plan that protects your account when you must have encountered series of losses. Let's say you lost about 8 to 10 trades in a row. You lost about 8 to 10 trades in a row. This plan helps protect your account. It helps you not to blow up your accounts. Some people lose their trading accounts in 2 trades. Someone might have a $5,000 account and the person will lose it in 5 trades because they don't know how to manage their risks. But if you have a good risk management plan, I'm telling you bro, it's gonna protect your account, and even if you lose 10, 11 to 12 trades, your account will still have enough money to trade with. I hope you're understanding what I'm saying. Even with a winning strategy, if you don't have a risk management plan, if you don't know how to manage your risk, I'm telling you, you will lose a lot of money, because you might win 10 trades but immediately you lose 5 trades, you're gonna lose your money. So watch this video to the end. I'm sorry it might take a longer time. Now before we dive into how to calculate our risk, let's talk about risk to reward ratio. Most people must have been hearing about risk to reward ratio, but they don't really understand what risk to reward ratio is. Risk to reward ratio is used by traders and investors to manage their capital and risk of losses. They use it to manage their capital and the risks of losses. This helps assess the expected return of a given trade. In other words, it helps you know how much you lose or gain in a particular trade. So when you understand what is risk to reward ratio, it helps you know how much you are likely to gain in a trade and how much you might lose if the trade fails to go to your direction. So I'll be explaining this with a simple example. Let's say you have a $1,000 account and you risk $100 on a trade and your profit target is $200. You risk $100 and your profit target is $200. That is what we call a 1:2 risk to reward. I hope I'm making myself clear. You are risking $100 to make $200. That is a 1:2 risk to reward ratio. Another example here, let's say you risk $50 in a trade. That is, you are willing to lose $50 in that particular trade if it fails to go to your direction, and your profit target for that particular trade is $100. You are risking $50 for $100. This is equally 1:2 risk to reward. ratio. I hope you're understanding what I'm saying. Let's say you risk $100 in a trade and your profit target is $300. We are risking $100 to make $300. This is 1:3 risk to reward ratio. That is, you are making 3 times of what you are risking, and that's how it goes. If you risk $100 to make $400, that is 1:4 risk to reward ratio, and it goes in that sequence. Hope you're understanding what I'm explaining. Now I have a quick question for you and I want you to answer the question. Let's say you risk $500 in a trade and your profit target is $500. What is the risk to reward ratio? I'm giving you 3 seconds to answer. Have you answered your question? Let's go. If you risk $500 in a trade and your profit target is to make another $500 in that particular trade, that is what we call a 1:1 risk to reward ratio. I hope you're getting what I'm saying. If the trade goes to your direction, you win $500, and if it goes against your direction, you lose $500. That is 1:1 risk to reward ratio. I hope I've explained risk to reward ratio, but in case you are still confused, let's use this example to make it clearer. And this example is going to help you understand the best risk to reward ratio to use. For me, I don't trade any setup that has less than 1:4 risk to reward ratio. Sometimes I get trade that gives me 1:8. Some even give me 1:12 risk to reward ratio. But if the trade is less than 1:4, if I see any setup that is less than 1:4 risk to reward ratio, I don't take that trade. So I expect you to choose your own. Try things out. I always say try things out on your own and know the best risk to reward ratio that works for you. Let me explain this with this example to make things clearer. Let's say we have 2 friends. The first friend, his name is Solomon, and the other friend, his name is Wisdom. These 2 friends, they have the same amount in their trading account. They have $500 in their trading account. Solomon has $500 in his trading account, and Wisdom equally have $500 in his trading account. And they always take the same trade. They stay together. They take the same trade. But Solomon trade with 1:2 risk to reward ratio, and Wisdom always trade with 1:1 risk to reward ratio. And they usually risk $100 in each of their trade. They take a very high risk. They risk $100 in each of their trade, and they take the same trade. Now let's see what happens. They took the first trade, they lost the trade. That is, Solomon lost $100 and Wisdom equally lost $100 in that trade. They took the second trade, Solomon lost $100 and Wisdom equally lost $100. They took the third trade. Man, is their strategy not working? I don't know. Okay, they took the third trade, Solomon lost $100, Wisdom equally lost $100. At this point, they were more careful to understand what was going on. They took the fourth trade, Solomon won $200 because he's risking $100 to make $200. That is 1:2. And Wisdom, that is risking 1:1 risk to the reward ratio, he won $100. They took the next trade, they won the trade. Solomon won $200 and Wisdom also won $100 in the trade. They took 5 trades in that week and they lost 3 of their trades and won 2 of their trade. Now Solomon, that is trading with 1:2 risk to reward ratio, he made $100 at the end of the week. Not a lot of profit, but at least he is profitable. Wisdom lost $100. Why did he lose $100? They were using the same strategy, they were risking the same amount, they had the same amounts in their accounts, but Wisdom lost $100 at the end of the week. Why? Because he is trading with 1:1 risk to reward ratio. His risk to reward ratio is not profitable because he loses the same thing when he enters a trade and he makes the same thing when he enters a trade. Now, have you seen the importance of using a favorable risk to reward ratio? Like I've said before, I don't trade anything less than 1:4 risk to reward ratio. That is, even if I lose more than 5 trades in a week and I win 2 or 3 of my trades, I will end up being profitable. So it's left for you to try things out on your own and know the best risk to reward ratio that works for you. Now, knowing the amount you risk on each of your trades is very, very important because that plays an important role in protecting your trading accounts. You know, both of them are taking a very high risk. They have a small account of $500 and they are risking $100 in each of their trade. You know, that is a very, very high risk. So if you have such accounts, you can reduce your risk. Knowing the amount you risk on each of your trades can be very, very important. Knowing if you risk 1% of your account, 2% of your account, 3% of your account. Know how much you risk on each of your trades. Let me give you one more example before I teach you how to calculate the best lot size for your trading account. So we still have these two friends, Solomon and Wisdom, and they have a $500 trading account. They have the risk to reward ratio of 1:2, and Solomon risked $50 on each of his trade, and Wisdom risked $100 on each of his trade. So when they started trading for the week, they took 5 trades in a row and they lost the trades. That is, Solomon was losing $50 on each of those trades. Now Wisdom, on the other hand, has blown his account very quickly and easily because he was risking $100 and Solomon was risking $50. Now after that, they continued to trade and Solomon won 3 trades. After the 5 losing trades, Solomon won 3 of his next trades, which gave him $100 each, which is he made $50 at the end of the week. While Wisdom, on the other hand, lost his whole trading account because he was taking a very high risk. He wanted to buy a penthouse in the next 3 months. So trading that way is not the best. Know how much you risk on your trade. If you have a small account, a big account, know how much you risk on each of your trade, and this will actually protect your trading account. I hope I've made myself clear. Okay, now how do we calculate the best lot size for our trading accounts? What is lot size? Lot size is the amount of units of currency that you buy or you sell. It is the amount of units of currency that you buy or you sell. For those who trade futures, it is called contracts. Now, what are the things we consider before we calculate the lot size we use on each of our trades? The first thing you consider is your account size. Know how much you have in your trading account. Once you know how much you have in your trading account, secondly, you now determine the risk you take on each of your trade. That is, how much you risk on each of your trades. Do you risk 1% of your account? Do you risk 2% of your account? Do you risk 3% or even 10%? You check how much you risk on each of your trades. After you must have checked how much you risk on each of your trade, what next do you consider? You consider your stop loss. That is, you calculate the size of your stop loss. So how do we calculate our stop loss? You know, we have mathematical way we can actually calculate our stop loss, but TradingView made it easy for us. So I won't be using the mathematical way of calculating the stop loss. I will use TradingView to calculate. So if you don't have TradingView, please try to use one because it makes trading easy. You can use this tool right here, the measuring tool right here, to measure your stop loss, to know your stop loss. So let's say you placed your stop loss from this zone to here, 28 pips. The stop loss here is 28 pips. Let's say you even went over to place your stop loss below here. You place your stop loss below here. You have about 97 stop loss. You know, you can actually risk the same amount. Let's say you are risking $100 on each of your trade. You can actually risk the same amount when your stop loss is 97 pips and 28 pips. You can risk the same amount. We're going to Google right now to calculate best position size for our trading account. So when you get to Google, what you type in is lot size calculator. You see it, you type in your lot size calculator. So this is it, lot size calculator, and the one I usually use is the one for cashback Forex. I usually use those ones. We have other ones by Baby Pips. We have my FX book. I have many of them here. So I usually use the cashback Forex. So the lot size calculator, I use this one by cashback. Let's open and see what we got. This actually works on your mobile phone. Let's say you don't want to use your personal computer to calculate it. You can actually calculate using your mobile phone. It's the same process, very clear. Let's continue with the example. Let's go back to the trade and see the pair we were actually trading. Okay, we are trading the GBP USD, and we will check for the first one. The first one we got about 27, and this is it. You can come here, choose the instrument you are trading. A lot of them are here. Choose the instrument you're trading. Right here we are trading GBP USD, and our stop loss size is 27 pips. Our stop loss is 27 pips. And now the currency you are trading with, you can come down, choose the currency. We have a lot of currency right here. You choose the currency you are trading with, and your account size. Like I said, we are using a $1,000 account. Now, how much do you risk on each of your trade? Let's say on this trade we want to risk, we have a $1,000 account and we want to risk 2%. We are risking 2% of our trades. Now you can calculate. So you can actually see the calculation right here. If you are trading the currency pair, you can see it right here. That is, you can trade with 0.07 lot size. Since you are risking 2% of your accounts, you can leave the approximation right here. If the fall was up to 5, you can actually approximate it to 0.08. So for those that are trading futures, this is the amount of units you can use. So you see, we are risking 2% of our account. That's actually giving us the lot size we can use for this trade. Okay, let's do one more. Let's say our stop loss is placed here, and how do we use the same amount of risk for the trade? Our stop loss is placed below here. If you remember our calculation, we got about 90 something pips. We got about 97 pips. So let's calculate now. Let's say you have a bigger stop loss. You have about 97 pips. After you have 97 pips, so you can calculate now. Have you seen? It has reduced the lot size. You can actually use 0.02 lot size, and for those trading features, this is the units you will use. So this is how we calculate our lot size before we enter a trade. You can always come back, choose the instrument you are trading. If you are trading Euro USD, you can actually type it out. Make sure you always come back to change it when you are trading a different pair. Change it. Always type in your stop loss and type in your trading account. If you risk 2% of your capital on each of your trades, type it in. If you are trading a $10 account, yes, I know most people trade with little amounts like this. If you are trading with $10 account, type in the risk. 1%, you risk 1%, you risk 0.5%, you risk 2% of your account. Type it in and come down here, calculate the lot size, and it will definitely give you an answer. So this is how it is done. You can actually go back now, choose the best risk to reward ratio you use, choose the amount you risk on each of your trades, which will help protect your trading account, both big and a small account, and try to be the best trader you can be. Thanks very much for being part of this video. Many people are requesting that I should do a top-down analysis of how to trade using supply and demand zone with break of structures, liquidity, and the entry confirmation I talked about. I might consider to make a video on that if I'm chanced. So thanks for watching this video today. Remember, this is still me, Solomon Wisdom, aka Born to Trade, and please kindly drop a comment and equally like the video. If you haven't subscribed to this channel, I don't know what you are waiting for. Subscribe. Thank you.